Greetings, everyone. Happy July 4th weekend. So here we are, Employment Friday, in the know. And just wanted to reiterate that the drill here is fiscal policy, monetary policy, economic indicators, market indicators, and we will feature many of the charts that you've seen, just updated, to give you a sense of where we think we are. So as you know, we believe we've been going through a rolling recession for the past 3 years. We are seeing a lot more indicators softening here, particularly relating to the consumer and to housing. Housing has been very weak for a long time. It seems to be relapsing here. Again, these interest rates are just too high for the housing market, unless prices come down a lot. And prices are starting to tick down. So the other thing to focus on, since it is Employment Friday, is employment is a lagging indicator. And some of the statistics associated with employment are beginning to look quite weak. And that's not surprising to us, as we believe, reaching the end of this rolling recession with some certainty on tariffs, the tax package, so the big, beautiful bill, and the wars, both Ukraine and the turmoil in the Middle East, as those start clearing up, perhaps, or at least some of them. And we do believe we'll launch from a rolling recession into a rolling recovery that we think will gather momentum as we're exiting this year into next year, with productivity the big surprise, and real GDP growth benefiting. We also think the other surprise will be inflation, much lower than expected because of productivity. Now, a lot of people associate real GDP growth with higher inflation. The higher the growth, the higher inflation. If you look at history, that's absolutely wrong. The higher the growth, the higher the productivity, and productivity is a potent anti-inflationary force. And we think that's going to be the case this time, perhaps more than ever, because of all of the deflationary undercurrents associated with the explosion in new technologies, catalyzed especially today by AI, which is, as we've gone over in the past, extremely deflationary. Good deflation. The more costs fall and prices fall, the more units explode. That is how we usually exit recessions, or in this case, a rolling recession. And we think this time will be no different, except it will be more exaggerated than usual. So I'll go through a few points first, and then we'll go through charts. On fiscal policy, well, today I think the House, after an all-nighter, is probably in the last throes of a vote. By the time you get or watch this, we may have a bill. We know there are some holdouts, but there's a lot of arm twisting too, and I have a feeling it will be successful. So we will have the bill. The most important variables to us are tax rates. The fact that tax rates are not going to go up at the end of this year is very important. And I think that's true. That's all the same in both the House and the Senate. And then on the spending side, we know there's been a lot of drama around this package, especially Elon Musk's opposition to it. And I do believe Elon understands that government spending is taxation, and that is why he's railing against more government spending. But I think what is also happening is that the forces that he put in motion through DOGE and through the people who are still at work in this administration are lowering employment and evolving a different mindset inside the government. So I don't think that this is as bad as Elon is suggesting. These deficits, yes, I agree, are terrible. But if his first impulse as he was leaving the government plays out, meaning, okay, I guess I'm going to have to do a lot when it comes to innovation in order to spur growth, to help us grow our way out of the deficit. That's what he said as he was leaving initially. He's reverted a bit, but we actually think he is right. That first instinct was right. Get growth going, and that's how we're going to lower the deficit. Then on monetary policy, and we'll go through the slides in a moment, we have seen M2 accelerate, and many people will think, oh, goodness, when I say accelerate, the growth rate on a year-over-year basis has accelerated to, I think it's roughly 4.5% or thereabouts. Many people are probably thinking, okay, this is the beginning of an accommodation of all of this profligate government spending. Well, if you look at money in the context of history, this is still a very low growth rate. But we're also seeing at the margin signs that that monetary policy is too tight. Now, we've talked about the yield curve a lot, and as measured by the two-year Treasury yield versus the 10-year. And that has moved back into positive territory, meaning the 10-year Treasury yield is higher than the 2-year Treasury yield. But if you look at the shorter end of the curve, the 90-day T-bill rate versus the 2-year yield, you'll see the inversion is in place still. We've got to basically flat on that basis, and now it's reverted. And that does suggest that monetary policy is probably erring on the side of too tight. So we'll get into that as well. I will say, listening to Chairman Powell over the last week, he's probably admitting to what I just said, because he said, well, you know, if we didn't have the tariffs upon us, we'd probably be easing. And I think what's also interesting about the last month is, despite the tariffs that were put in place in April, we now have May statistics and some June statistics that would suggest very little of those tariff increases are making their way into the pricing structure of this economy. We are seeing certain categories that have been hit hard by tariffs increasing in price, but that's being offset elsewhere in lower than expected prices. So the overall indices are behaving quite well, 0.1% for both the CPI and the PPI and the PCE deflator in the last month, which all of those were surprises on the low side of expectations. And we'll show you some charts on that as well. And then on economic indicators, before I launch into the charts, employment typically Friday, but this month, Thursday, provided something for everyone. I do think, though, when more economists dig more deeply into the report, they'll find, on balance, it was a weak report. So headline looks stronger. So non-farm payroll came in at, 147,000. But surprisingly, about half of that was government, not federal. Federal government employment fell slightly, but state and local increased quite a bit. taking out government, private payrolls were up only 74,000 month to month. And there's a plug in the employment report each month, and it's called the birth-death ratio. It's the birth of businesses versus the death of businesses and the employment associated with both. And the working assumption this year is that month to month it has been in the 80 to 100,000 range. So if you take out that plug, employment could have been negative. ADP, the ADP report earlier this week was negative 33,000. It is more overweight with small and medium businesses, and that's probably where we're seeing a shedding of employment. We saw average hourly earnings well behave, 0.2. I think on a year-over-year basis, they are now about 3.7%. And if we're right and productivity starts accelerating here after a few negative quarters associated perhaps with 2 negative GDP quarters, the first negative GDP quarter, first quarter, was actually revised down with consumption a big part of the downward revision. But once we get through those negative quarters and productivity picks up again, we think it will go north of 2%. So 3.7% year over year for the average hourly earnings, minus 2% or more, would suggest that underlying inflation, if you're looking at labor, is below or will be below 2%, which is what the Fed wants, and we think what the Fed will get. One other source of weakness in the report was the average work week. It was down, and many people don't pay much attention to that, but that can have more of an impact than the change in employment itself. So another sign of weakness. And if you look at the household survey was in the 90,000 range. So again, sub 100,000. So on balance, I would say a weak report. The bond market may have anticipated a much weaker report because of how ADP set us up earlier in the week. So it's down a bit, but bond yields have been very well behaved in the last month, especially with all of the drama around the deficit. So with that, let's launch into these charts. So the first chart here is the budget deficit. Now, it's very hard to see on a month-to-month basis, but actually in the last few months, the budget deficit has come down slightly as a percent of GDP already. You can see here the green line and X depicts where Treasury Secretary Bessent aims to take the deficit over the next 3.5 years. And if our outlook for growth driven by productivity is right, we think he will be successful. So we think that the tide is turning here, and we think the surprises could be on the low side of expectations, meaning the deficit shrinking as a percent of GDP more than people expect. And on the next chart, you can see we featured this last month. The reason we're featuring it again, the corporate tax rate, is it does look that in both the House and the Senate versions of the bill, that full expensing of capital equipment and some structures has made it into the bill, which would take our effective corporate tax rate down into the 14 to 15% range, which will be one of the lowest in the world, certainly in the developed world. And one reason we do believe foreign direct investment will increase in this country. On the next chart, here you can see what I mentioned about M2. M2 is closing in on 5% growth. That's depicted in the purple line here. But if you take a look over history at this chart, you'll see that even that rate is at the lower end of what we've experienced over the years. Now, what's also interesting on this chart is in the 60s and 70s, you'll see M2 growth on a year-over-year basis was outpacing inflation. It was accommodating all kinds of government spending. And you can see that this is pushed ahead by 18 months, that if we're right, the inflation rate is going to come down. And the controversy out there, and I think what Treasury Secretary Bessent has been trying to guard against, is that we don't end up in another 70s accommodation period, which led to terrible inflation, double-digit inflation. If we're right, this environment is going to look much more like the 90s, where money growth is above the inflation rate, and actually inflation tends towards a decline. And what that will mean is that the velocity of money is slowing down. Now, the velocity of money, I know I've featured it in charts in the past, but it's been in a secular downtrend since a secular decline. The growth rate had been slowing quite a bit, but the actual decline started in the late 90s. With the occasional cyclical bump. Well, we've just been through the cyclical bump, and velocity is starting to turn down again. So that trend is important. If it's still in place, then money growth at this level is not at all a problem in terms of feeding inflation. The velocity is the rate at which money turns over. And why would it decline? Well, if we're right and inflation is much lower than expected and interest rates will follow, including mortgage rates, then the attitude is, well, I don't have to rush now to buy anything because inflation and interest rates are coming down. That's how you get that psychology. And we think that will be at work during the next few months, if not years. On the next chart, here you can see what I mentioned a little earlier, which is the inverted yield curve at the front end of the curve, the short end of the curve, so the 2-year Treasury yield versus the 3-month Treasury yield. The longer term yield is below the shorter term, which is not normal. And you can see how abnormal it has been. We've had that inversion in place pretty much since the Fed started jacking interest rates up dramatically, the most dramatic move ever in percentage terms, in percentage change terms. And it's been inverted ever since then. And this is one reason we believe we've been in a rolling recession. And the headline numbers obfuscate this rolling recession. But if you go sector by sector, manufacturing, down and out, housing, down and out, small businesses constrained by all kinds of metrics, monetary policy is too tight. And it's getting tighter in recent months, as you can see here. This may be what Chairman Powell was reflecting on when he said, maybe without tariffs we'd be easing. On this next chart, here we're going into some of the economic indicators. So this is a chart from RenMac, a service that we use. It's a very good service. And what you see here is the unemployment rate in the dark brown. And in the gray, you can you can see the labor differential. So labor differential is based on a conference board metric. Jobs easy to get minus jobs hard to get, or maybe it's the other way around. Jobs hard to get minus jobs easy to get. And based on that metric, the unemployment rate is probably going to continue moving up. Now, what happened in this report, it actually ticked down a bit in today's report from 4.2 to 4.1%. One of the reasons is the labor force is shrinking, and probably what's behind that is immigration, the crackdown on illegal immigration, and the deportation of some people. So that could be holding the unemployment rate down. This metric, the labor differential, says it's getting harder to find a job. The other metric that suggests that is continuing unemployment claims. They have been rising even while initial claims have been pretty stable. And what that suggests is people who have been out of work are finding it difficult to get a job. And we do know that AI is certainly hurting entry-level jobs. I may have mentioned this the last time. We did our own hackathon at ARC during our offsite, and we now have 13 projects that we internally started coding ourselves. I did a little bit, although I have to give credit to Dan White more for our team getting a project going. Dan White is our associate portfolio manager. And yet 13 pain points within the organization we started addressing ourselves. So this idea of natural language, not processing, but programming. We all speak a natural language. Generative AI is all about natural language programming. And so it is one reason we think software as a service is going to run into a little bit of trouble here now that we can do a lot ourselves and customize to our own organization's needs. The other thing I'll note about this employment indicator is the Wall Street Journal published an article about college graduates having a difficult time getting jobs. And that's what I mean by entry level. If you look at the statistics, what you'll find is the unemployment rate is up. I think the recent low in that metric was 4%, and we're up above 6%, 6.3 or 6.4%, I think. So it is true that college graduates are finding it difficult to get a job, and AI is probably the reason. So the lesson here, anyone who is thinking about changing a job or looking for a job is start focusing on AI. There's a lot you can do yourselves, and follow Frank Downing, who's our director of research on the next generation internet broadly, but on AI specifically, and Joseph Soya, who is a research analyst. Follow them on X. Follow people they follow who are really transforming the world with AI, and learn a lot about it. There's a lot you can do to up your game in that particular realm. On the next page, another indicator that that there is some stress out there when it comes to employment. You can see these are Google searches on how to file for initial claims, initial unemployment insurance claims. You can see it shot up right after the election because I think a lot of people thought that, oh no, this is this is going to be a very terrible environment, and we better figure out, if we're going to lose our jobs, what to do next. That kind of settled down. The tariffs have probably set it off again, as well as this notion that AI is starting to displace some jobs, or maybe remove jobs entirely, so they're no longer there for the entry level. So here is real GDP versus productivity. Real GDP is in the purple, and you can see how this rolling recession has been obfuscated, I think, holding real GDP growth up over the last few years as housing has crashed and manufacturing has really been under a lot of stress, has been the government sector, and now that's starting to give way, and the high income part of consumer. And we know from sentiment indicators that their sentiment has diminished as well with all the uncertainty around tariffs and geopolitical risks. So we think the bias here in this number is down. You can see on a year-over-year basis, even during recessions, look at the early 90s, that was the S&L recession, it barely went down. In the tech and telecom bust, it didn't go down. We needed two shocks, the global financial crisis caused by mortgages and COVID to get it down in any big way. You can also see productivity. You can see how it picked up in the 90s. One of the reasons that, as the internet was taking off, one of the reasons inflation did stay very low. And you can see it has been languishing at a fairly low level relative to what we enjoyed during the late 90s. We think we're going back to that level and well beyond in a secular sense. I think you've heard us say that we could see real GDP accelerate to the 7% range in more of a sustained way than you see in this chart because of productivity and all of the new technologies proliferating. And we do think that's going to be a big antidote to the deficit problem out there, that the deficit as a share of GDP, we would not be surprised. It might take a while, 5 to 10 years, but we will move back into a surplus situation, we believe. Much like Reagan got the ball rolling during the 80s, but we needed 10 years to get get back into a surplus situation under Bill Clinton and Newt Gingrich. And then on the next chart, here's an illustration of where manufacturing has been. Look at it. It's below 50. 50 is the demarcation point here between expansion and contraction, and our manufacturing sector has been contracting for a long time. We had a little bit of a blip there, and now it's back down. And you can see that non-manufacturing in the green is also tending towards contraction. So again, this rolling recession is now beginning to hit the services sector. And we're seeing in consumption, and I'll show you that chart. So you can see consumption, it had held up very well. Again, government employment, high income earners really spending. And we think it's now starting to tick down. We got retail sales negative in May, negative by a lot, 0.9% month to month. We saw personal consumption also negative in May. And I do think some of the uncertainties are now being expressed through consumption. But you can see consumption, it takes a lot to get it into negative territory. Here you see the two major recessions we've seen over history. So just wanted to illustrate. I know why people think we haven't been in a rolling recession. It's a chart like this, and now it is starting to weaken. Here on the services side, you can see and I did present this the last go around, but new orders have responded to that price increase. The prices in purple, new orders went negative, and I think the statistic here is we have never seen this wide of a gap, or I don't think we've seen this wide of a gap since the 70s, if I'm not mistaken. I may be a little bit off on that, but unlike, or it would have been the early 80s, unlike the 70s when higher prices stimulated activity as consumers and companies said, let me buy now before prices go higher. This is a very different dynamic. So again, those worried about the 70s environment, and I think Chairman Powell's one of them, this chart would suggest not to worry. Here you can see auto sales. We had the spike pre-tariff, and now it's giving way. We're back to 15.3, and we would not be surprised to see this go actually much lower because unlike during other recessions, we have alternatives like Uber, and even autonomous alternatives if you don't want to get into a car with a stranger, and apparently many people don't. We have Uber and Lyft, and then we have Waymo, and now for the first month we have in Austin Tesla's autonomous service, which it is now, I think within the last week, started to offer more broadly than just to those invited. So we think we're on the threshold of some very exciting times in transportation, but they could hurt auto sales significantly. And one of the reasons for that is especially, well, even with Ubers and Lyfts today, the capacity utilization of those cars is much higher than our personal cars. We drive our cars 4 to 5% of the time if you use a 24-hour period. Uber and Lyft, 25% of the time. Autonomous could be even higher, 50% or more. And therefore, the need for more cars on the road or to be purchased goes down. Here's capital spending, so continuing through the sectors of the economy. You can see it's actually responded to the interest rate hikes and flatlined in here for the last few years. We think, even though AI and power generation has been a huge stimulant to capital spending, the rest of capital spending has been given way. What I find interesting about this chart is you see a triple top from the late 90s to the global financial crisis, and then in the 2012 to 14, and then a quadruple top right before the COVID. Now capital spending is being stimulated by these data centers and AI generally. And we do think with this corporate tax cut that I mentioned and illustrated earlier, and certainty in the tax package, that capital spending will pick up. Capital spending has a huge multiplier on economic activities, so that's very good. Here you can see the trade deficit around the tariff. The pre-buying got us to a record-breaking deficit, and now it is normalizing. In the last month, reported I think was May, exports dropped 4% month to month. That's a huge drop. And imports were flattish. So a little bit of deterioration there. which we'll see if it continues, could become a drag on GDP growth in the short term. Here, just to feature housing a bit, which is technically a part of investment in the GDP accounts. You can see this is new and existing home sales, very, very weak by historical standards. And I remember I started in the business when I was in college in the late 70s. This number was higher back then than it is now, and the population is much larger. So housing is, I think, going to be a source of significant strength going forward as interest rates fall and maybe prices fall to clear the market. And you'll see in a moment why we think that will happen. But there's another very interesting twist in the last week or so. The FHFA, headed up by Bill Pulte, who was, I don't think he is or can be as a government employee, chairman of Pulte Homes. He has just issued a directive to allow crypto currency to count if it's on a centralized exchange in the U.S. like Coinbase, to count in the analysis of whether a person is qualifying for a new a new home or an existing home, because this is agency supported mortgages. So that's very interesting, and I think important, maybe more important than many people understand, because young people have been hodling, holding on for dear life, a lot of different cryptocurrencies, and they don't want to sell them. So now they'll be able to use them to qualify for mortgages. And we think that could open up the housing market more than most people think. Well, here is why prices could go down, especially in the new home sector. So this is new one-family houses for sale. And you can see we're reaching for levels that we saw during the global financial crisis, which was a massive housing crisis. The inventory, in other words, for sale, has tripled certainly since the early teens, so 2011, 12, 13, to now. And I would say that's not voluntary. And we are hearing more and more about home builders buying down loans, so they're helping to subsidize homeowners as they're buying homes. We also think we know prices are starting to fall, and that's on the next page here. So you can see new home prices in the purple there. They have been slipping for a couple of years now. And you can see existing home prices. If people were sort of paralyzed, stuck in their homes because they were not going to sell their existing home, which has a 1.5% to 2.5% mortgage rate on it, for a new home that would have a 6.5% to 7% mortgage on it. So what the heck? I know I can't move, so I'm not going to cut my price. That's what was going on in the existing home market. If you look today at the two price levels, the existing home prices have been coming down very recently. And I think both new and existing home prices are at the $413,000 level, somewhere in there, maybe 415,000, somewhere in that range. So we do see prices starting to fall on the existing home side as well. And to clear that inventory, we'll probably see more price declines. And that's going to feature heavily in, just to flip back, that's going to feature heavily in the CPI and the personal consumption deflator. I think it will get into those indices with a big lag and will be sustained for a long time. And I think it'll be one of the main reasons we'll see some periods of deflation in the CPI. Now, many people are saying, no, the CPI, that inflation rate's going up. One of the reasons they're saying that is the comparisons to last year are very difficult. So last year around this time, we had a few months of 0 and 0.1% increases in the CPI. And those are the comparisons against which this year is. And so maybe we stay around here in the 2.4% range for a month or so. But I think with shelter as a driving force, that we will drop below 2%, could be by the end of this year. Now, consider the source. I thought that transitory inflation, which you look even on this home price, you can see inflation was transitory. And I think history will judge it as being transitory, as well as for the CPI as well. I would have expected 2% a long time ago. It has taken time, but I do think the inflation is resolving on the low side of expectations. I just wanted to put into context the dollar once again. Many people say it's crashing, and yes, we've had the worst start of the year since 1973. And yet, putting it in context, you can still see that certainly relative to where it has been, it's much stronger than it has been in the last decade or so, 10 to 15 years. Another way, this DXY is against 6 major countries, including the Swedish krona, which I was surprised to see. I thought it was the Swiss franc, but no, it's the Swedish krona. The next one is against 26 countries, trade-weighted again, but including emerging markets. Here's what the dollar looks like. It's strong by historical standards. And again, this is more a comment on weakness in other currencies, perhaps, than dollar strength. If you look at the gold price, the dollar has not been strong at all. It's been losing purchasing power. But if you look at it relative to 26 other currencies on a trade-weighted basis, it still looks to be quite strong. Here you can see the ramifications. Commodity prices, again, still pretty flat in the context of the last 40-ish years, which many people are surprised to see. I will say the copper price has moved back above $5. And so many people think Dr. Copper is the commodity with the PhD, more because of what it says about the real economy than perhaps what it says about inflation. So copper sensitive sectors, we know electric vehicles are copper sensitive. We know that data centers have an intense amount of copper, so that's probably what's going on there. And then just quickly going through some more market indicators. Gold's purchasing power is going up not just against the dollar, but against metals. So the purple line there is metals relative to gold. And I do think, as I have presented this chart to economists and strategists I respect, like Art Laffer, their conclusion is, okay, somewhere in the world there's a lot of weakness, and we do think it's in China, and it's still property. That bubble is still bursting. We are still surprised that the 10-year Treasury bond yield here is levitating. Given what's going on in the past, that the 10-year bond yield would probably have dropped closer to 1%. Instead, it's still over 4%. So I know a lot of people are saying, well, that's foreigners leaving the U.S. dollar and leaving the U.S. For all kinds of reasons, tariffs and other policies. But I do think that once this news cycle around tariffs and so forth and the deficit, once those two are behind us, that the long-term Treasury yield could come down, not to 1%, but could come down maybe into the 3 to 4% range, which may be a new range, and I'll get into that in a moment. Here, again, this has been an interesting test. The S&P to gold. Those who think we have an inflation problem spurred by government spending and deficit spending expected a breakdown like we saw in the 70s. And so we've been testing that thesis here, and you can see there's a triple bottom so far. The S&P is now starting to go up relative to gold. And on the next chart, you'll see what has been the leading indicator there, and that's S&P to oil. And now that we have Saudi Arabia basically saying, yes, we're going to put another 400 to 500,000 barrels on the market, even with oil prices at this level, we think this indicator will continue to move up, which is very much unlike what happened in the 70s, late 60s and 70s. And then here is that long-term Treasury yield. We think that the 40-year bull market is over, mostly because the Treasury yield will normalize. We're not at 0% Fed funds rate anymore, and the market is starting to work again, and that's what we want. We don't want to go back to 1%. But if inflation is going to be as low as we expect, even if growth accelerates, we'll see short rates really responding much more to the growth rate, and long rates tuning in to more to inflation. And if inflation's going to, below 2%, maybe even 0%, as we expect, then the Treasury bond yield should probably drop into the 3 to 4% range. And then just a couple of more. Always look at the high yield spread, so the difference between the high yield, so more junk-like bond yields, and the 10-year Treasury yield. Near its lows, had a little spike around tariffs, and now moving back down, and so the bond market doesn't have a care in the world. Now, we do wonder if there's just too much capital flooding the credit markets, especially with all these private credit funds. And so maybe the signal is being distorted by that. I don't know. But if it is, that will end badly. And then finally, always have to mention Bitcoin here, Bitcoin to gold. Gold was gaining purchasing power over Bitcoin late last year into this year, but now Bitcoin has turned and moving back. I know it's threatening new highs. It's been very interesting to watch Bitcoin during this period. It has been acting not as much as gold has, but it's been acting like a risk-off asset. More people are willing to hold it and gold, especially during the market tremor. I know we ended up in a bear market by some metrics during or right after so-called Liberation Day, early April. But Bitcoin has maintained its uptrend relative to gold, did not break. And I think that's a very, very positive thing. Even during the Iran or the bombing of the Iran nuclear facilities, Bitcoin really held its own. So I think it's still in the bull market as our on-chain analytics led by David Puel suggest that we are still in a bull market for Bitcoin. And I do think you can say the same now about the equity markets. A lot of investors were faked out during both the tariff turmoil and that weekend around the war intensifying in the Middle East. And the equity market is powering through all of this. I really love bull markets like this because what's happening is the equity market is climbing a wall of worry. And what's been fantastic about this time around is it has not been an unhealthy bull market like it really was from from 23 to 24, when the concentration towards just a few stocks was at its extremes. The market is broadening out, so it's much healthier now while it's climbing this wall of worry. So I think you could say we are quite optimistic for the future, especially given the way we see a rolling recession evolving into a rolling recovery and then into a productivity-driven boom in economic activity, accompanied by much lower than expected inflation.